Hi friends, I am now starting with recording a fresh concept videos. You have already watched my earlier concept videos which were recorded maybe 2 years back, and those videos have been extremely useful. It had 1 lakh plus views. Thanks for the trust in me, and different chapters you have benefited. I am starting with that series. I'm starting with mutual fund chapter. I'll release that video today, and as time permits, I'll keep recording new videos. These concept videos are going to be extremely handy in understanding concepts, because I think in the recent attempt we have seen the kind of difficult paper ICI has set. So getting grip on concepts will be very critical. So the focus of these videos will be only concepts discussion with good examples, no question solving. I may do a quick discussion if time permits in a chapter, mostly no questions discussion, only concepts, but with good examples. MCQ examples and all will be there. So it is not that numbers will not be there. Numbers are going to be there. Concepts will be discussed with numbers. You can understand all the concepts with the numbers. All that will happen. But proper descriptive questions we are not going to do. So a student who just wants to revise concepts and wants to practice on their own, this is the best videos you will find. You want to do concepts as well as questions, then see my concepts, do questions, or get my classes in that scenario, exam oriented batch or a regular batch. I leave that to you. But just to concepts you want to refresh, or you want to do self-study of concepts first. Even a new student can go through this. Self-study you want to do, you can do it. At places, you should pause the video and do some solving. At places, you may have to watch the video again. All that, as you see the videos, you'll understand. But focus is going to be on the concepts. Only concepts understanding. Get full grip on concepts. And I think success is what you are going to get. Paper was tougher. We don't know how the paper is going to be in future. I am not sure. You are also not sure. But our side is we will focus on concepts. So in the concept book, concepts are covered. Along with that, you should also read the theory book also, because ICI is asking theory concepts also in exam. So theory book you have to read, or theory videos you may have to see. But practical concepts, majority will be covered in these videos. Sums, after the concepts are seen, you can solve with my question bank or my last priority material. I released last priority material. You can see those priority material basically includes different types of questions which can be important from an exam point of view. Same may not get repeated, but concepts will get revised. Now, I with this pass it on to the first chapter for you. Any place you need any extra guidance, any support, let me know. Go through all the videos. Share with other friends of yours if you have got benefited. Like the video, subscribe to our channel, and keep providing your comments so that we can improve further. And I record other chapters. When I record other chapters, I take your inputs for my other chapters. So you do provide your comments on the video so that I consider those and try to give you a better output for the other chapters. As of now, I am releasing one by one. In case you want to cover all the chapters at a stretch, then you can see even my older concept videos. But this, I am now covering it one more time, just to see if at all anything got missed out. Not majority is missed out. Most of those concepts continue. But in case something got missed out, all that will get added here. Thank you, friends. Hi, friends. We are now starting with the revision of mutual funds chapter. I said the initial context of the chapter. We'll understand what is mutual fund, who are the investors in a mutual fund, what different plans are there in mutual fund, what are the forms of returns computation we have, something called as a holding period return and annual return. We learn little bit on the taxation side of the mutual fund. Then we learn how the NAV is computed of the mutual fund, open-ended plans, closed-ended plans, ultimately the performance evaluation measure. So let's go one by one. We'll do a detailed concept revision. Let's first understand what is mutual fund. See, it is basically a financial instrument for long-term wealth creation. Short-term investments can also be done, but primarily for long-term wealth creation. Let's understand what is mutual fund. See, let us assume I start a new batch of classes and some 100 students join our classes. Now these 100 students are paying me 10,000 rupees. Not for the classes, this is for managing the money. So 100 students into 10,000 rupees, I do something called as a new fund offer. New fund offer. In the new fund offer is the first time collection of money of a mutual fund. I do a new fund offer, collect money from the students, and let us assume we call this as AFM mutual fund. AFM mutual fund is what I am creating. In this mutual fund, the investment has been done by lot of you people. Lot of people are making the investments in the AFM mutual fund. You all students are unit holders. You all are unit holders of the mutual fund. Basically, you are giving me money, trusting my ability to manage money, and I am the fund manager. There are a lot of other things here, but basic thing which a mutual fund does is it collects money from like-minded investors. What is like-minded investors? Is those set of investors whose objective or whose risk-taking ability is similar. Some people want to participate in gold investment. There's a gold mutual fund. If 1,000 people are having similar view, all these 1,000 will put money in a gold mutual fund, equity mutual fund, debt mutual fund. So multiple mutual funds are there. Objective is very simple. Mutual fund is going to invest, So basically what it does is it pools means it collects money from large number of investors, invest them as per the investment objective. There will be an objective which would be mentioned. The objective could be long-term wealth creation in the form of equity investments or gold investments, or certain short-term investments can be done, which is debt kind of an investment. Basic thing is there is an objective. The objective will tell what an investor can expect from a mutual fund. For example, let's quickly see investment objective of PPFAS Flexi Cap Mutual Fund. This is one mutual fund which is there. Investment objective is to generate long-term capital growth from an actively managed portfolio consisting of equity and equity related securities across large, mid and small cap stock. This is what PPFAS Flexi Cap Fund will do. Highly successful mutual fund in the practical world. This is their investment objective. If I like this objective, I give money to PPFAS Flexi Cap. So I may float a mutual fund called Dinesh Jain Mutual Fund. And if you like my objective, you please give the money. Like we have this, for example, there can be a ICICI Gold FOF fund. There's some fund like this. Primary objective is to generate returns by predominantly investing in ICICI Prudential Gold. Scheme aims to provide return that closely correspond to the domestic price of gold. So if gold is your objective, go ahead and invest in this mutual fund. Create returns for the investor in the form of NAV appreciation as well as dividend. NAV appreciation and dividend is what it is going to pay. Now, let's understand how a mutual fund is created or what role does a mutual fund play. MF is like a financial doctor. You have a health doctor, normal doctor. Normal doctor takes care of your health. Financial doctor takes care of your wealth. He is going to manage the investor money. See, today in the stock market, there are 50 large cap companies, 50 next 50 companies, Nifty next 50, 150 mid cap companies, 250 small cap companies, 250 micro cap companies. There is 750 top 750 companies. Now in this 750, I don't know which company to invest in. I want to invest in equity markets. Equity generally gives more return. I want to invest in equity market, but I don't know where to invest, how to invest, which companies are good, which companies are bad, when to enter, when to exit. Don't worry. There is a mutual fund. They will play this role. They will have a research team. They will undertake the research and identify where exactly investments have to happen. So there is a sponsor. This is an entity that establishes the mutual fund and gives the initial capital. Side by side I show you. Sponsor of ICICI AMC. ICICI AMC, Asset Management Company. The sponsor are ICICI Bank Limited and Prudential Corporation Holdings Limited. Sponsor, so ICICI Bank formed an AMC called ICICI Asset Management Company, which basically does investments on our behalf. Multiple schemes they have. One example I showed you, ICICI Prudential, your gold ETF FOF. Sponsor is there. The sponsor are the people who are giving the initial capital, and they establish. Here we have ICICI Bank and Prudential Corporation Holdings Limited. Then trustee. First let's see who's the trust, which company is the trustee here. The trustee is ICICI Prudential Trust Limited, almost similar name, but the objective of the trustee is it ensures MF operates in the best interest of the investor. See, you believed Dinesh Jain, gave money to Dinesh Jain. I have to do investments on your behalf in a my mutual fund name is called AFM Mutual Fund. When I'm doing these investments, I don't want to invest in extremely bad companies, because if I invest in very bad, extremely poor companies, the investor will lose the money. So what happens is there is a trustee who sits on top of me. They are responsible for seeing that you comply with SEBI regulation, protecting the interest of the unit holders. So best interest of investor. Who is investor? Unit holders. Investor is unit holder. Then comes the asset management company, which does the managing the fund investment. It will have a big team and all. It takes care of receiving money from the investors, investing that money, doing research, answering questions of the investors, returning the money to the investor. So a big role is being played by the asset management company. AMC role is to manage the investment. AMC role is to manage the investment. When it does it, it incurs various expenses. The AMC incurs expenses like rent, salaries, professional charges, audit fees, commission, other things. All these expenses are recovered as part of something called as expense ratio. What is expense ratio? As we proceed, we'll discuss here, but it is recovered as part of the expense ratio. And then comes one major party, which is you all. You are the investor or unit holder. You give the money. You give the money, and you are technically the owner of the mutual fund. You are technically the owner of the mutual fund. You give us the money. This is basic introduction. In the context of this first concept, mutual fund return versus the individual return. Now I'll keep going to one by one concepts. We'll predominantly focus on concepts, maybe take some examples, but primarily focus on example. MF return versus individual return. What is this concept all about? Let's understand. Let's understand that I have a mutual fund scheme, whatever be the name. It earns 20%. It earns 20%. But what happens is, in this 20% which the MF is earning, it has to pay its expenses. It has to pay its expenses, which is called annual expense ratio. Annual expense ratio. What is expense ratio? Under later discussion. It has to pay its expenses, which will be classified or which will be expressed as a percentage. It has to pay its expenses, which is called annual expense ratio, Also, when I start a mutual fund, when I'm starting period is called NFO, new fund offer. When we start a mutual fund, it incurs your initial expenses. It incurs initial expenses, which is called initial expense ratio. So MF is earning 20%. Investor can't get 20%. This is the first concept. MF is earning 20%. MF return versus individual return. Return to be earned by the MF. What is that and all in some discussion. Because when you start MF, there is an initial expense, one-time expense, start a mutual fund during new fund offer. During the new fund offer, we are going to incur initial set of expenses. These expenses are unavoidable in nature when you start a mutual fund, like flotation cost for a share issue. Annual expense are recurring expense ratio, incurred every year to meet the regular expenses, salaries, rent, commission, audit fees. All expenses have to be recovered from the investor. So there is a formula. I'll come to the formula in a minute. Let's understand what is going to happen. Investor return will be less than 20%. MF is earning 20%. Investor is going to earn less than 20%. This is a bigger story. The bigger story is, and a question may say, investor is earning 20. Investor wants to earn 20. How much should the MF earn? Investor wants to earn 20. How much should the mutual fund earn? How much should the mutual fund earn? Our mutual fund is earning 20. How much will the investor get? In order to understand this, let's understand my annual expense ratio. My example, 5%. Okay, not 5, this is very high, 2%. Annual expense ratio is 2%. Initial, when you start, 4% expenses. When you start, it is 4%. Then now comes the formula. You may want to note down these things, note it down, the formula part and all, or the concept book has it. So be in listen mode, understand everything. You want to solve something along with me, please solve it. Okay. So the formula we have here is MF return, individual MF return and individual return linkage we are going to do. MF return is equal to individual return divided by 1 minus initial expense ratio plus annual expense ratio. I will explain this formula logic as we proceed. Let us understand now. The investor wants to earn 20%. Investor wants 20%. Okay, investor wants 20%. So individual return 20. Individual return 20. Just give me a minute. Individual return 20. That is the individual return he wants. Okay, so we are calculating how much should the MF earn for that. Initial expense ratio 4%. Let's write in decimal only, 0.4. Annual expense ratio 0.2. I divide this now and then I'll explain the logic. 0.20, 0.96. Let's keep 4 decimal. 2083, 02, 2283 are 22.83%. If the mutual fund earns 22.83%, I will be earning 20%. Mutual fund earns how much? 22.83%. I will earn 20%. This is what the first concept is saying. Mutual fund has to earn 22.83% for me to get only 20% return. For the investor to get 20% return, MF has to earn 22.83%. 22.83. Now understand the logic. Logic is very simple. MF earns 22.83%, pays 2% for expenses, net leftover return 20.83%, earned 22.83, 2% expenses met, net leftover is 20.83. Now the problem is this when I invested in the mutual fund 100 rupees. But when the mutual fund got it, it got only 96. I gave 100 rupees to the mutual fund. It received only 96. It received only 96. What is 96? 100 minus 4 rupees. 100 minus 4 rupees. 100 minus 4 rupees. So effectively, MF earns 20.83% on 96. On 96. On 96, which is 20%. Which is the 20% return the investor wants. MF return is equal to individual return divided by 1 minus initial expense ratio plus the annual expense ratio. Plus the annual expense ratio. This is one thing. I may repeat the same thing again. This is reverse working. Anything can come in exam. I'll repeat the logic again. 22.83 MF earns, 2% expenses met, 20.83 left over. This 20.83 is effectively earned on 96. Is effectively earned on 96. Effectively earned on 96. What is 96? I gave 100 minus the 4% expenses. 100 minus 4% expenses. So effective earning is 20%. This is the first part. Okay. Same formula if I want, I can say 0.20. That is the MF is earning 20%. 0.4 annual expense ratio 0.2. Now I am doing the other calculation. So what happens here? 0.18, 2 goes to the other side, into the denominator comes here is the individual return. Is the individual return. So if the MF is earning 20%, individual will get 17.28%. Individual will get only 17.28. So whenever in the practical world you select a mutual fund, please check its annual expense ratio. Higher expense ratio, lower returns for the investor. This is one part. Second part is something on cost benefit analysis. What is that? Let us understand now. First part is how much should the MF earn so that it is able to replicate. It is able to replicate the individual return. Individual wanted 20%. MF has to earn 22.83. Now next story. Next example. Next example. This is with opportunity cost. MF final MF return after expenses, everything is 15%. MF return after expenses 15%. Dinesh Jain return own investment 20%. Dinesh Jain can earn, if I directly invest, I can earn 20%. Mutual fund can give me only 15%. Obviously, I'll invest on my own. That is better. MF is giving me 15%. Dinesh Jain own return is 20%. Next example. The example will make it clearer to you. MF is 15%. Dinesh Jain 20%. Portfolio value 1 crore. Portfolio value is 1 crore. Portfolio value is 1 crore. Loss, net loss in MF investment. Net loss in MF investment is 20% minus 15% into 1 crore. 5 lakh rupees is the loss. Net loss. If I go through mutual fund investments on my own 20%, on the MF it is 15%. Effectively, I am going to lose 5 lakh rupees. I'm going to lose 5 lakh rupees if I do the investment, through the mutual fund. Then comes the bigger story. My Dinesh Jain professional income for a year 90 lakh. For a year 90 lakh. This is my professional income. What is my professional income? I have a chartered accountancy practice and I'm earning 90 lakhs in that. I'm having a chartered accountancy practice and I'm earning 90 lakhs in this. I'm earning 90 lakhs in the practice. I spend 90% time on profession and 10% time on managing 1 crore portfolio. Managing 1 crore portfolio. Managing 1 crore portfolio. My professional income is 90 lakh. I've been spending 90% of my time on my profession, taking classes, doing CA practice and other things. 10% time my portfolio I manage. If I stop managing the portfolio, if I stop managing the portfolio, extra 10% time I stop managing. What is stop managing? Giving it to the mutual fund. I'll give it to the mutual fund. Extra 10% time can give extra income of 10 lakh. Can give extra income of 10 lakh. What is this extra income of 10 lakh? 90% time was earning 90 lakh. Extra 10% time, I can earn extra 10 lakh. I can earn extra 10 lakh. So now understand the bigger story. See, if you give to MF, you lose 5 lakh rupees. You lose 5 lakh rupees. You lose 5 lakh rupees by giving it to the mutual fund. But you earn extra 10 lakh. You earn extra 10 lakh by taking another batch of AFM classes or by taking extra clients and doing a good practice. So one thing which you need to be aware is lot of the for example, big fund managers are even people who are in MD position and other things, who are having good knowledge of finance. They may themselves still not do their investment because managing the investment needs time. So lot of people give this money to the MF and tell them, you please manage it. You please manage it. We don't want to manage our money. I give it to you. You please do proper investments and generate returns. I can earn 20%, but 15% from MF looks to be, because see here, net benefit of MF, extra income of 10 lakh and loss of 5 lakh net gain of 5 lakh. Understand the example again. You want to note down some of this, you note it down, but understand the example. See, MF return 15% after all the expenses. Dinesh Jain return 20%. Extra 5% I can earn. If I do investment on my own, extra 5%. Extra 5 lakh rupees. Problem with that is, I'm wasting time. If I give that time to my profession, I earn extra 10 lakh. So now I have to take a call. Extra 10 lakh active income is better or extra 5 lakh investment income is better? I'll obviously choose extra 10 lakh. Lose that 5 lakh, net gain of 5 lakh. This is that concept. You will see examples around this. Do cost benefit analysis. A person is required to spend time while investing on his own. Investing through mutual fund will save this time. Same can give extra income. If a question gives data on this, should prepare a cost benefit analysis of own investing versus MF investing. Example 1 on without opportunity cost. Example 2 on with opportunity cost. MF 13%, portfolio value, own investment, professional income, all that is there. You please do this 2 examples. I have done another example so that you kind of understand. At this stage, you can pause the video also. Pause the video, go through example 1, example 2. With the class itself, it will get over. Pause, solve example 1, example 2. I'll now go to the next. Holding period return versus annual return. Holding period return versus annual return. Let us understand this now. Holding period return versus annual return. Now, one thing which you need to be aware is, what is return? Because there has to be a proper definition of the term return. Without a proper definition of the term return, we can't proceed. Now, what is this definition of the term return? Let's understand. Return for anyone, what I get back minus what I give divided by what I give into 100. Time period and other things can come. For example, I invested in a property. I invested in a property. I gave 1 crore. I gave 1 crore for the property. I gave 1 crore for the property. Only 1 year investment. Okay, 1 year investment. At the end of the year, sold property for 1.2 crores. Sold property for 1.2 CR. Got rental income of 5 lakhs. Got rental income of 5 lakhs. And now I need to calculate the return. This is a very simple example. Invested in a property, 1 CR for the property. End of the year sold property for 1.2 CR. Also got rental income of 5 lakh. Basic example to understand what is return. Basic example to understand what is return. Now, how will you calculate? I think some of you would have calculated by now when I gave the example. At any stage, you want to practice certain things on your own. Please pause the video. Okay. Pause the video and do your practice. Whatever you want to do, certain practice, that's the best way of learning. Best way of learning is you do on your own also. So, what I get back from the property is 1 crore 20 lakh and 5 lakh and 5 lakh, and I give 1 crore divided by what I give, 1 crore into 100, 25%. 120 plus 5 lakhs minus 1 CR divided by 1 CR into 100, 25%. 120 plus 5 lakh minus 1 CR divided by 1 CR into 100, 25%. Same logic now MF will take care. Same logic. What is the same logic for MF? MF logic is what I get back is called NAV1. What is NAV? As we discuss, you'll understand. NAV means the value of the mutual fund. 1 means closing, 0 means opening. Closing can be any time period. Okay, end of the month, end of the quarter, end of the year. NAV1. I also get something called as D1. D1 means dividend 1. Dividend, I earn dividend from the mutual fund. CG1. What is CG1? I'll explain. Minus NAV0 divided by NAV0 into 100. This is called holding period return. What is annual return? As we proceed, NAV1. So what is NAV1 is closing NAV. Closing NAV. How NAV is calculated as we proceed. Okay, closing NAV. NAV is basically like a share price, like the share price which you call T1 P0. NAV is closing NAV. D1 dividend paid by mutual fund to the investor out of its regular income. What is this? Just 2 minutes. CG1 again, dividend paid by mutual fund to the investor out of its realized capital gain. Out of its realized capital gain. See, mutual fund may give dividends to the investor. The source for paying the dividend, the source, because dividend means money has to be there, no? The source, from where are we getting that money? That money could be got through the capital gain realized by the mutual fund. Through the capital gain realized by the mutual fund. What is capital gain realized by the mutual fund? Mutual fund does a lot of buying and selling. They keep buying buying shares, selling share. In the process, they earn a capital gain. Dividend can be paid out of the realized capital gain. Can be paid out of the realized capital gain. Can be paid out of the realized capital gain. Can be paid out of the realized capital gain. That is called CG1. That is called CG1. Technically, there is no difference between D1 and CG1. I don't know why ICI confuses the two terms, or why they, because practical world there's no D1, CG1. It's just dividend. Dividend means dividend paid out of the regular income. What is regular income of the mutual fund? Mutual fund may earn income like interest income, dividend income, all that. What is irregular income? Capital gain. Technically, both are dividend. NAV0, opening NAV. For example, there is a mutual fund whose NAV at the end, is 12 rupees. It paid a dividend of 1 rupee, capital gain distribution 1 rupee, and it had an opening NAV of 10 rupees. Opening NAV of closing 12, opening 10, divided obviously by 10 into 100, 40%. This is the holding period return. This is the holding period return. Closing minus opening. Closing can be monthly closing, quarterly closing, annual closing, whatever is the end period. Variant of this is, variant of the holding period return is, variant of this is annual return. Annual means very simple. Just do into 12 by number of months. For example, this calculation is for 3-month period. So do 12 by 3. If the computation was done for 3 months, do 12 by 3. If this closing NAV was monthly, do 12 by 1. If it's yearly, 12 by 12. If it's half yearly, 12 by 6. Rare. This closing is after 3 years, 12 by 36. 12 by 36. 12 by the period. 1 month, 12 by 1. 1 quarter, 12 by 3 months. 1 half year, 12 by 6. 1 year, 12 by 12. If you know exact dates, some question will say 1 year consists of 365 days. Then you can also do 365 by 30 days, 365 by 30 days, or 365 by 90 days, 91 exact date if you have. And they say 1 year consists of 365 days. The word 1 year consists of. So you see here, holding period return, NAV1, NAV0, D1, CG1, NAV0 into 100 to express. Multiply this with 12 by M. Multiply this with 12 by M. Multiply this with 12 by M. For example, this earlier we did holding period return. Now I repeat, annual return, 12 by 1. 12 by 1. Annual return 12 by 1. This becomes 480% per annum. 480% per annum. 40% is holding period return. Annual return is 480%. And what is this 40%? Technically, it was for a month. Now, this can also give you one more thing. What can it give? One more thing. For example, I hope this example is clear. What I get back minus what I give divided by what I give. Any doubts you have, let me know. What I get back minus what I give divided by what I give into 100. Without 12 by M is called holding period return. With 12 by M is called annual return. Without 12 by M is called holding period return. With 12 by M is called annual return. Then they can do something like this. Another example. Holding period return 20%, annual return 30%, compute time period. Holding is 20, annual is 30. Holding is 20, annual is 30. Very simple, very simple. What can I say? Annual return is equal to holding period return into 12 by M. Into 12 by M, because extra 12 by M we added there. Extra 12 by M we added in the formula. Annual return is equal to what? Holding, this has come in exam. Reverse working, and they'll ask what is the date of investment or what is the time period of investment. Or you can do 365 by number of days. When we do 365, question will specifically say 1 year consists of 365 days. If such words are there, you have to follow this calculation. For example, I'll show you that. If specific words are there, 1 year consists of 365 days. In entire financial AFM, be clear on this. Wherever question uses the word, I'll show you first. Yeah, assume 1 year equal to 365 days. Some words like this there, you have to You have to do only yearly calculation, daily, that is 365 by number of days. 365 by number of days. Otherwise, month's calculation is fine. So this 30 equal to 20 into 12 by m. 20 by 20 into 12 by m. Net m equal to 240 by 30. 8 months. 8 months. This is another thing which ICA may ask. Annual return equal to holding period return into 12 by m. Again, some examples are there. You try these examples. You try this example 3 and 4. Example 3 and 4. Pause the video. Solve the example 3 and 4. Solve the example 3 and 4. Okay, this we have already discussed. Period of holding can be computed through holding period return and annual return. Through the holding period return and annual return. Don't get into the formula. Understand the logic. Annual return equal to 12 months. Holding period return equal to question mark. So this is 30 in my previous example. 20. 30 equal to 12 months. 20 equal to question mark. 20 equal to question mark. Again, this number of days in a year 365. If something like that is there, please do calculation 365 by D consistently across entire AFM. And I think this is what is mentioned here. Question specifies a year consists of 360 or 365 days. Do return computation. What is return computation? In this formula, instead of doing 12 by M, do 365 by D. 365 by D. Days calculation has one headache. I'll explain. No such information. Do computation on months basis. Do computation on months basis. Now there is a headache to days calculation. What is that headache? Starting NAV January 1, 10 rupees. Starting NAV January 1, 10 rupees. Ending NAV Jan 31, 11 rupees. No dividend, no capital gain, nothing is there. No dividend is there, no capital gain is there. I want to calculate the annual return. So I'll use the formula. Annual return. I'll use the formula. Annual return. This and all. And I'm doing 365 by D. I'm doing 365 by D. No problem with this. Here I do 11 minus 10 by 10 into 365. Now D, there is a problem with this days. Jan 1 to Jan 31 can be 31 days. Or I say January 1, please exclude it. January 1, please exclude it because I invested at the end of the day. January 1, please exclude it. Then the number of days is 30. Somebody may say, no, January 1 also exclude. Jan 31 also exclude. Jan 1 also exclude. Jan 31 also exclude. Then it is 29 days. This is a headache whenever we do days calculation. Month, no headache, 12 by 1. Month is no headache, 12 by 1. So when you do days calculation, Jan 1 to Jan 31 can be 31 days. Jan 1 to Jan 31 excluding January 1. Excluding January 1 or excluding January 31. One of the days you exclude, 30 days. Both the days you exclude, 29. I feel most of the time ICA will exclude one of the day and will consider the other day, but not consistent. Okay, there also I can't be very sure. Sometimes they'll consider both. So Jan 1 also in days calculation, Jan 31 also in days calculation. Only Jan 1 considered, Jan 31 not considered, or Jan 31 considered, Jan 1 not considered. Both not considered. Both not considered. Obviously, subtle difference will come in. MCQ, no problem. I can put a tick. Descriptive, this headache will come. If time permits, you may give multiple answers, but it's very difficult because 3 answers can come. 365 by 30 can come. 365 by 31 can come. 365 by 29 can come. Which is right? They all depends on the extra information. When did we invest and when are we redeeming it? When did we invest and when are we redeeming it? Investment made on March 1, redeemed on March 31, can be taken as 31, 30, 29 ICI hasn't been consistent. ICI hasn't been consistent in including or excluding. If consistency is there, okay. Best don't go extreme 31, don't go extreme 29, do 30 and then leave it. Clear? With this, concept 4 is over. We have done till concept 4. Now we proceed to concept 5, which is on dividend payout versus a dividend reinvestment plan. Let's first understand what are these two plans. Before even I start this, understand one thing is dividend. Dividend which a company gives or dividend which a mutual fund gives can be expressed from a company point of view. One is dividend rate. If there is a dividend rate, if they give a dividend rate, dividend is equal to dividend rate into face value. Second, there's a dividend yield. The students don't understand this very clearly and make mistake. In this case, dividend is equal to dividend yield into market price per share. Market price per share. This is if you do a per share calculation. In case of mutual fund, you can say DY, dividend yield, into NAV. NAV or investment made by us, or investment made by us. Dividend rate is multiplied with face value. Dividend yield is multiplied with market price or the NAV or the investment, because investment is allotted at the NAV, or investment made by us. Dividend yield into market price per share or dividend yield into NAV or the investment made by us. And there's a third thing, dividend payout. This is more relevant for a company. Dividend is equal to EPS into payout ratio. EPS into payout ratio. So the dividend can be expressed in three ways: dividend rate multiplied with face value, dividend yield multiplied with MPS or NAV or the investment made by the investor, or dividend payout, EPS into payout ratio. Now, okay, once this dividend is determined, two things can happen. Two things with the dividend. First is three ways to calculate the dividend. Can be rate, can be yield, can be payout. Rate multiply with face value, yield multiply with market price or NAV, payout multiply with the earnings per share. One is called dividend payout plan, paid in cash. Paid in cash. If they ask us to calculate returns here, use the HPR or annual return formula which you learned at the top. Use HPR or annual return formula which we have learned at the top. We have just now learned it some time back. Use that formula. If the dividend is paid in cash, return computed using formula of concept 2. In case there is a reinvestment, then something else has to be done. Something else has to be done. What is dividend reinvestment? Second is dividend reinvestment plan, not paid in cash, but extra units are given to the investor. 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 What is this extra unit story? Let's understand this now. See, let's take example itself. Date, opening balance, dividend rate, dividend in rupees, NAV, extra units, and closing units. What is this? Let's understand the workings properly so that you understand the concept very clearly, because very important is getting clarity on the concept. For example, Mr. X invested 1 lakh when NAV was 10 per unit. Let's call it as day 0. Day 0. I got 10,000 units. 1 lakh when NAV was 10. This is my start. I started with this. I started with 10,000 units. Fund declared income distribution and capital distribution of 3 per unit. These were reinvested at 20 per unit, closing 20. What is the rate of return? Next, XX date, I don't know. We had 10,000 units. Rate is not okay. Dividend rate, they have not given percentage, but they said 2 per unit and 3 per unit. So dividend technically is 5 per unit. Dividend technically is 5 per unit. They may give a percentage. You will see that example as we proceed. 5 per unit. In this case, dividend is equal to 10,000 into 5, 50,000 rupees. 5 per unit, 50,000. This, instead of giving you cash, I give you extra units. There will be a reinvestment NAV. These were reinvested at the rate of 20 per unit. Reinvested at the rate of 20 per unit. 50,000 divided by 20. Another 2,500 I got. Reinvested at the rate of 20. See, that 2 per unit could have been reinvested at something else. 3 could have been, but here they have said this is what has happened. I end with 10,000 plus 2,500. I'm ending with 12,500. Started with 10,000 units, ended with 12,500. Started with 10,000, ended with 12,500. How am I going to calculate the return? I have to go back to this formula. Technically, this formula. Return is what I get back minus what I give divided by what I give. What I get back is closing value 12,500 units into closing NAV 30. I gave 10,000 units into 10 divided by 1 lakh into 100. That's all. This is closing value minus the opening value. Into 12 by M you can do if you want the annual return. Holding period return without 12 by M. Holding period without 12 by M or with the 12 by M, you can do 12,500 into 30 and 10,000 into 10 divided by 1 lakh. Divided by 1 lakh. That is that entire calculation. 275%. 12,500 into 30, 10,000 into 10. This is another concept which you need to be aware. Dividend, but the important thing is dividend rate is applied on face value. Yield is applied on NAV. Yield is applied on NAV. Rate is applied on face value. Yield is applied on NAV. Okay. Computation of closing units. But before that, we need to understand there are 4 types of plans in a mutual fund. When you invest in PPFAS Flexi Cap, practically they give 2 options, but you can have 4 options as per our study material. What are these 4 options? Let's understand one by one. So MF plans, what are the plans an MF give? Growth plan, no dividend payment, no bonus units. If we start with 1,000 units, we will end also with 1,000 units. Very simple. If we start with 1,000, end also with 1,000 units. No increase or decrease in the number of units. Decrease though can't happen. No increase in the now growth plan means no dividend payment, no bonus units. If we start with 1,000, we will end with 1,000 units. If we start with 1,000, we'll end with 1,000 units. Okay, this is first plan. The second plan is bonus plan. In a bonus plan, no dividend. But as the name indicates, extra bonus units will be given. Extra bonus units will be given. How does this work? Let's take similar table. I don't need so many things. Date, opening balance, bonus ratio, bonus units, closing units. Format can be slightly up and down. I have created formats for everything. How does this work? You understand it very clearly. We started with 10,000 on maybe Jan 31, 10,000. They declare a bonus of 2:4. 2 units for every, or 1:2. 1:2. So I will be allotted extra 10,000 into 1/2. Extra is 5,000, ending 15,000. Then March 31, 15,000 is my start. Now again bonus will be declared. Again bonus will be declared. This time they are declaring a bonus of 3:5. 15,000 into 3/5 into 3/5, 9,000, 24,000. Don't worry on the numbers, understand the concept. Then maybe on June 30, again a bonus is declared, 1:6. 24,000 into 1/6, 4,000, 28. So this is how we'll have to calculate the closing units, because formula, they'll ask us to calculate return. What is return? What I get back minus what I give. What I get back is 28,000 into something. What I give is 10,000 into something. What I get back is 28,000 units into some number. And what I give is 10,000 units into some number. What I get back is 28,000. Bonus plan. MF will declare bonus, which will increase the number of units in hand. For example, this is the example. Invested 1 lakh on 1/4/2015. I'll do this here. 1 lakh on 1/4/2015. We invested 1 lakh. NAV was 25. So we got 4,000 units. We got 4,000 units. Then 1:4 on 1/10/2015. 1/10/2015. 4,000. Ratio is 1:4. So which is 4,000 into 1/4. Very, very simple approach. Closing with 5,000. Next to bonus. 1:5 on 1/4/2017. 1:5 is again 1,000. We are ending with 6,000. Then 2:5. Then it is 2:5. 2:5. 2:5, which is 2,400. We are ending with 8,400. This is one requirement which can come, because there can be reverse working, forward working, all those question solving I'm not going to do in this discussion. Question solving you do on your own, but examples and everything I'll try to spend time so that you get full grip. So this is one thing which we do. MF plan, bonus plan. Third is, this is how you calculate the bonus units. The format could be slightly up and down. Date, unit held, I called it as opening balance, bonus ratio, bonus units, total units. Dividend payout plan, which I've already discussed. MF will declare dividend. Same would be paid to the investor. What you purchased on day 0 will be equal to the units redeemed on maturity. On the last day, the number of units. On the start, the number of units. Both will be same. Start units equal to end units. Start units is equal to end units. Dividend reinvestment. We just now saw that date, opening balance, dividend rate, dividend amount, reinvestment NAV, new units, total units. We just did one example for your discussion. I did this example like that. You will have one more example, but here units redeemed on maturity will be higher. If the exam question just uses the word dividend plan, ICI takes it as dividend reinvestment plan. There are good number of reverse working questions which have come in exam. So after concept video is understood, parallelly if you want, you solve the questions also. But focus is first giving you the clarity on concept. Where do I solve question? You take my question bank and solve questions from here, or take my priority material which I released for the earlier attempt, that also you can take and solve questions. So this is the question on these plans. Question 8, which is a reverse working question, or question 7, or question 6. Different questions are there. You can pick any question and then do it. Clear? This is reinvestment plan. You may want to pause and solve this MCQ if you want. Solve the MCQ at this stage. Dividend will be on face value. Face value on face value. Dividend yield specifically given on the NAV. Clear? Okay. Then now comes the next concept, which is on return for close-ended schemes. Let us understand what is this first. Okay. Two types of schemes are there in the practical world. Two types of schemes are there. Open-ended schemes, entry into MF and exit from MF can happen anytime. Can happen anytime. Units are purchased. Units are purchased directly from AMC, from the asset management company, or from the MF. Redemption is also from MF. Open-ended, you can buy and sell anytime. Here buying and selling will happen at NAV. Buying and selling will happen at NAV. I'll give an example so that you understand a little better. For example, particulars, NAV, something else. This is for some other purpose. Okay. Opening price or opening value 20, closing value 25, nothing else is there, no dividend and other things. Okay, return is equal to return. This is for an open-ended scheme. Return is 25 minus 20 by 20 into 100, 25%. 25 minus 20 by 20 into 100, 25%. This is open-ended scheme return calculation. NAV, how is it calculated? As we proceed, I need time to discuss every concept. Open-ended scheme. Okay. Close-ended scheme. Entry at the time of new fund offer / specified intervals. They may specify some interval also if they wish, which can also be called as interval fund, but they can specify entry normally at the time of new fund offer and exit at the time of winding up of the mutual fund or some specified interval. Now what happened is, I didn't understand all of this. I didn't know there's an open-ended scheme, close-ended scheme as an investor, because many people don't understand everything clearly. So I purchased this mutual fund. I purchased the mutual fund and was thinking, okay, good mutual fund purchased, we will generate good returns, and it had a period of 10 years. It had a period of 10 years. I didn't even know all this. I just purchased it. After purchase, 2-3 years later, I wanted to exit. But exit is not possible because mutual fund will continue for 10 years. This winding up is winding up of the scheme of the mutual fund. 10 years I cannot exit. So this mandatory to be listed in stock exchange, and this is called as exchange traded mutual fund or exchange traded fund, ETF. You can call as exchange traded mutual fund. It is mandatory to be listed in the stock exchange. What will happen because of this? I wanted to enter, but I could not enter on the start date. Go to the stock market, press a buy order, someone else will be pressing a sell order, and you can buy the mutual fund. You wanted to exit, press the sell order, somebody else will press the buy order, and he can exit. Now the problem is, this is now a close-ended scheme. The close-ended scheme. 2025 understood, but there's a problem now. Same scheme, if it was close-ended, NAV has to be declared by the MF every day. So NAV is 20, but market, it is at a premium of 5% and it's 21. I don't know, market is at a premium of 5% and it is at 21. It is at 21. This got tested in the recent exam also. The close-ended logic, 21. When I exit, unfortunately, it is a discount of 4% and it is at 24. Discount and it is at 24. So an open-ended guy will earn 25%. Same scheme. I may earn more or less depending on the premium. I can earn more also. Okay. 24 minus 21. 24 minus 21 divided by 21. 14.29%. 14.29%. I am unfortunately paying extra. It can be reverse also. When I purchased 20 minus 5%, when I exited 25 plus 4%, then I earn huge return. It can be either ways, but this is the problem with the close-ended. So in a close-ended scheme, formula is not NAV1, NAV0. It's called adjusted NAV1, adjusted NAV0, D1, CG1, all that will come in the formula. It can be holding period return, it can be annual return. So listed in stock exchange to facilitate the purchase and sale. Purchase and sale cannot happen at NAV. Replace with adjusted price. You please do this example by pausing now. NAV is there. Dividend and capital gain distribution is there. Discount and premium. Discount means lower value. Premium means higher value. Please do this calculation. You can pause the video if you want to do the calculation. Okay, next. Taxation impact. What is taxation impact is? Sometimes a question may be like this. What is this? This is a very good example. Sun Moon Mutual Fund. I purchased on this day. Some NAVs are given. I redeemed on 31st July. When I redeem, I have to pay securities transaction tax, LTCG, STCG. This may come in a question if they wish to. I don't see them testing it, but if they wish, if they give long-term capital gain and short-term capital gain in picture for calculation purpose, one STT is not tax deductible. To compute the amount of capital gain, what is capital gain? Sale value minus the purchase value. In the sale value, securities transaction tax cannot be subtracted. Securities transaction tax cannot be subtracted in the return computation. Sorry, in the tax computation. In the tax computation, STT cannot be subtracted. So if you are calculating STCG, which is less than 1 year investment, all this is your income tax part, less than 1 year, STT is not to be subtracted. For the amount I get back, what is amount I get back on the last day? Listen now, on the last day, what I get back is units into the closing NAV minus STT. I have to pay STT minus short-term or long-term capital gain tax. Minus the short-term or long-term capital gain tax. This is a good problem for you to practice. It will be a lengthy one if you want to practice this STT and STCG and LTCG. For capital gain, if you have any bonus units allotted, cost of acquisition is 0. Bonus units allotted, cost of acquisition is 0. Cost of acquisition is 0. With this, another 4 concepts got over. Okay, let's now proceed to the next concept, which is effective yield concept. Effective yield concept. Let me spend time on this because little tricky to understand initially. Now, let us assume effective yield calculation. Investment on day 0. Investment on day 0, 1 lakh rupee. Maturity value in year 3. In year 3, 1,40,000. 1,40,000. I invested on day 0 1 lakh, maturity after 3 years, closing NAV into closing units. One way of calculating return, which is what we normally do. Normally this is how return is calculated. Annual return equal to closing value, or what I get back, my same formula, what I give divided by what I give into 12 by M into 100. I get back 140. I give 1 lakh divided by 1 lakh into 12 by 36 into 100. 12 by 36 into 100. This is the answer we normally do for return calculation. 13.33%. Some question may ask you to do under IRR approach. How will they do under IRR? How will they specify IRR approach? They will use the word effective yield. Effective yield still doesn't mean IRR approach, okay? Effective yield word is used and something like this added in the question. Present value interest factor. If something like this is added, maybe IRR approach you can do. Maybe the IRR approach you can do to calculate the return. See, the formula approach ignores something called as time value of money. It basically says you earn 13.33% on 1 lakh for the first year. Same 13.33 on the same 1 lakh for the second year. Same 13.33 for the third year on the same 1 lakh. That is wrong. Reason is, second year I should earn on 1,13,333. I should earn on 1,13,333 because first year I earned some money, no? So this formula ignores something called as time value of money. What is effective yield? Very simple. Our IRR approach. What is IRR approach? Year cash flow PVF. I'll not do the IRR calculation and all. You would have learnt it at CA Inter fully. Year 0, investor invested 1 lakh. Year 3, he got back 1,40,000. Some random rate. What is that random rate? Below that question, they'll give the rates. No, I showed you. For example, here they've given you 2%, 4%, 8%, 13%. Somewhere those you can use. So PVF at, let's assume I'm taking 10%. 1 divided by 1.1 first year, second year, third year. 751 negative 1 lakh. 140 into 751. 105 140. NPV is 5140. Positive you have to increase the rate, maybe 12%. 1.00. now I do a 12%. 1 divided by 1.12 first year, second year, third year. 712. I get same 1 lakh. 140 into 712. 99 680. Negative NPV 320, and now we can do the IRR calculation. Everything will spend maybe when I go to capital budgeting concept discussion. IRR is equal to lower rate, NPV at the lower rate divided by lower rate NPV minus the higher rate NPV into the difference in rate. This is how you used to do IRR calculation. I'm not spending time on that as of now. 10 plus 5140 5460 into 2 At any place you need more clarity, play it at lesser speed, or you do the calculation at your end, pause the videos, all that you do. But effective yield, if they ask, or if they give values below the question, they ask return, better to do under IRR approach. IRR, exact answer is, what is 11.89 is on first to 1 lakh you earn 11.89. For example, in the calculator, 1 lakh, first year I earn 11.89%, it becomes 1,11,890. On this I earn 11.89%, becomes 1,25,000. On this I earn 11.89%, it is some 1,40,079. So I earn 11.89 on first year, second year 11.89 on a higher amount, third year on even a higher amount. This is better answer and accurate answer. but we still follow the earlier formula because our calculators can't get us IRR so fast. So ICA normally follows the other one. This is on the effective yield concept. An example is there, 2 lakh and 2,39,003. You can pause the video, do the normal calculation. What is normal calculation? Closing value minus opening value divided by opening value into 12 by m into 100, and then do the IRR approach. Whatever this method gives you annual return, take a rate closer to that, one positive, one negative. Please practice. Do practice this at home. Pause. Again saying examples. With the video itself, close it. With the video itself, close the examples. Front end load and back end load. Okay, this is also a good concept. Let's discuss on that now. Front end load and back end load. Back end load. Front end load is otherwise called as entry load. This is otherwise called as entry load, charged when a person buys units from mutual fund. When a person buys units from mutual fund, for example, I want to buy 10,000 units at 15 rupees, 1,50,000, but I have to pay 1,50,000 plus extra 2%, 1,53,000. I have to pay extra 2%. I have to pay extra 2%, 1,53,000. Extra 2%. SEBI and AMFI has abolished front end load in India. In India, it is abolished. Okay, front end load doesn't exist. Second, back end load is otherwise called as exit load, charged when a person is exiting the mutual fund. Exiting the mutual fund. When a person is exiting the mutual fund. Sell 5,000 units at 20. I should get 1 lakh, maybe minus 1%, and I get only 99,000. 1 lakh minus what? 1%, and get only 99,000. Get only 99,000 by 1 lakh, extra 2%. Exit minus 1%. Entry plus 2. Exit minus 1. Entry plus 2. Exit minus 1. Exit minus 1. Entry plus 2%. Exit minus 1%. Minus 1%. This is the story. Now, what is going to be asked? They will give you something like this. NAV of MF 10, public offer price 10.25. Public offer price 10.25. So what is, they may ask you the percentage. They may ask you the percentage of entry load. They may ask you for the percentage of entry load. Entry load percentage is equal to 10.25 minus 10. This is the load. You can divide this by 10 or divide by 10.25. ICI gives both answers. Okay. So if you divide by 10, 2.5% of NAV. If you divide by 10.25, you may get a different answer. You may get a different answer. If you divide by 10, 2.5%. And if you divide by 10.25, it is 2.44%. 2.44%. Entry 10 rupees NAV, but pay 10.25. Pay 10.25. That extra 0.25 is called entry load or front end load percentage. Similarly, NAV of MF10, redemption price. Redemption is exit 9.7. Redemption exit 9.7. In that scenario, exit load 10 rupees minus 9 rupees 70 paise can be divided by 10, can be divided by 9.7. I say I use both answer. Okay, can be divided by 10, can be divided by 9.7. Public offer price minus NAV by NAV, but division can also be by public offer price, can also be by public offer price. And for back end load, the denominator can be redemption price. Entry load and extra on entry increases purchase price, collected on exit decreases redemption price, Pause, complete example 11. Okay, now comes the net asset value of the mutual fund. I think I've been discussing this for a longer time, and I said I will discuss this NAV at some stage. Okay, now what is NAV? Net asset value of mutual fund. Certain points you have to understand. This is calculated daily. First point, okay. This is calculated daily by an MF, and daily means whenever trading is happening in the stock market. This is calculated daily. NAV equal to all assets minus all liabilities divided by number of units of mutual fund, divided by number of units of mutual fund. All assets minus all liabilities divided by number of units. This is a formula 1. There are other formula also. All assets minus all liabilities divided by number of units of mutual fund. Assets of MF equal to equity shares invested, debt invested, fixed deposits, real estate investment, whatever investment they've made. Calculate their market value, not cost price. Market value. All has to be valued at market value. You have invested in shares of TCS, take the price every day of TCS, and the value of assets will change every day. Value of assets will change every day. Assets and liability detail available. Market value of assets, value of liability, number of units. Assets include equity, debt, money market, cash, receivable, other assets. Everything value at market price. Market price means value will keep changing on daily basis. Value will keep changing on daily basis. Example. NAV equal to 1000 shares of TCS into 2500. This is one asset I have. 4000 shares of HDFC, I'm just giving random number, into 500 plus 10 lakh cash plus 15 lakh fixed deposit plus 2500 shares of Infosys into 600 plus, like this you can keep adding on. Okay, I'm not going to put a total also. All assets. Okay, all assets. Will the value change every day? Yes, the value will change every day. Minus, I may have some liability. What is liability? Salaries payable 5 lakh. 5 lakh of salaries payable. 2 lakh of rent payable. 20 lakh to be paid on shares purchased. I purchased the share, but I meant to make the payment. Do all this and divide this by number of units of mutual fund. Divide this by number of units of mutual fund. Number of units of mutual fund. So I will say NAV is equal to, I'll say NAV is equal to, just give me a minute. Screen got stuck. Sorry. Just a minute, guys. NAV is equal to all asset value is some 5 crore, some random number. Liability value is 20 lakh. Divide by units of mutual fund. Units of mutual fund is 20,000. some random numbers I've taken. Okay, so 480 lakhs divided by 20,000, NAV is 2,400. Now this will change on a daily basis. Assets value can change daily, liabilities can change daily, units can also change daily. What is units change? What is units is equal to? Now units is equal to ownership by the investors. Ownership by the investor. If some extra person comes in, units will increase. If a person exits, units will decrease. So units can also change on a daily basis. This is first formula. All assets minus all liabilities divided by number of units of mutual fund divided by number of units of mutual fund. If I have any example, I'll take that. Okay, I haven't put any example here on the first formula. All assets minus all liabilities divided by number of units. I'll give you some more example on asset valuation. An example can be TCS valuation through index. What is this through index? Let's understand. Purchase of TCS shares, rupees 20 lakh. Price they did not give. Purchase of TCS share, rupees 20 lakh. IT index on this date 1000. IT index is in the stock market. There is a Nifty index, like that you have information technology index. Valuation date, value of TCS, no idea, they have not given. IT index on valuation date 2,500. This is one way of doing the question also. So how will I do valuation now? Valuation date, value of TCS, I don't know, but they given IT index value. IT index value on the valuation date is 2,500. This is one way you have to value the assets. You have to value all the assets. How will I value? Very simple. 1000 index 20 lakh value, 2,500 index question mark value. Question mark value. This is to get market value of all assets. Market value of all assets. Market value of all assets. When you are doing the market value of all assets, this is one way of valuing. One way of finding out the market value. One way of finding out the market value of various assets. This adjustment is there in many places in the ICA questions. Okay, I am not getting into questions discussion. I just want to discuss concepts. So 2,500 index value will be 50 lakh. So in your asset valuation, take 50 lakh. In your asset valuation, take 50 lakhs. Take 50 lakhs. Okay. Then liabilities you consider, units you consider. One thing you need to understand is there is no relationship between units of mutual fund, shares of company. What is this? I'll tell you this, because students have been doing mistakes here. I'll show you a question. For example, it is asking for calculating NAV. So what do you do for NAV? Multiply, deduct your liabilities and get the NAV. For NAV, you have to divide by number of units, which is 10 lakh. But some student feels number of units is total of these four. No, there is no link at all. There's no link at all on the number of units of mutual fund and the shares which you are buying. For example, another question. Somebody enters and mutual fund buys some shares, 18,000 shares. They think number of units will go up by 18,000. No, number of units has nothing to do with the number of shares. Number of units has nothing to do with the number of shares. This is a constant mistake or doubt I get from students. Number of units has nothing to do with the number of shares. Don't add up them and then say number of units is equal to 10,000 plus 50,000 plus 10,000 plus 1 lakh plus 30,000 plus 18,000 or 8 lakh plus 18,000. No. Shares and units has no linkage. Shares and units has no linkage. This is one formula. Second formula is I don't give you the asset and liability details. This is also very simple. Opening net worth of mutual fund 2 lakh units at 25. This is the opening net worth. Opening net worth of the mutual fund, 2 lakh units are there. Rate is 25. New units issued. New units issued in MF, 50,000 units at 30. Some new people are coming into the MF, 50,000 units at 30. Units redeemed from MF, 20,000 units at 35. Capital gain earned by MF, 20 lakh. Dividend earned by MF, 5 lakh. Dividend paid by MF, 1 lakh. Expenses paid by MF, 6 lakh. They want closing NAV. No asset detail, nothing is there. Opening net worth is there. New units issued are there. Units redeemed are there. Capital gain is there. Dividend earned by MF is there. Dividend paid by MF is there. Expenses paid by MF is there. And then closing NAV. This is very simple. You need to calculate closing net worth. What is closing net worth? Opening 2 lakh into 25. Every transaction will increase my share capital and reserves and surplus, or decrease my share capital from a mutual fund point of view. If new units are issued, this will increase my capital value. This will increase my capital value. New people, new shareholders are coming, new unit holders, new people are exiting. This will decrease. Capital gain earned, increase reserves and surplus. Dividend earned, increase reserves and surplus. Dividend paid, decrease reserves and surplus. Expenses paid, decrease reserves and surplus. So 2 lakh into 25, 50,000 into 30. So 2 lakh into 25 is 50 lakh. 50,000 into 30 is 15 lakh. Minus 7 lakh. Don't worry about the numbers part of it, okay? In a hurry, if I make any calculation error, don't worry about it. 5 lakh minus 1 lakh minus 6 lakh. So 50 plus 15, 65, minus 7, 58, plus 20, 78, plus 5, 83, 82, 76. Even if there's a calculation error, don't worry about it, because students then tell me. And it's okay. My focus is just getting you the clarity of the concept. Closing units. Closing units is, we had 2 lakh. Extra units 50. Deduction 20. Deduction 20. Any concept you're not understanding, play it slower or go through it again. Go through it again, because my objective is to get you these concepts at the shortest possible time so that you can revise it multiple times. 2,30,000 units. NAV per unit, closing NAV. 76 lakh divided by 2,30,000. 76 by 230, 33.04. This is the second formula. If you don't have detail, opening net worth, items increasing net worth. What are the items which will increase net worth? Portfolio appreciation, dividend received, income earned, fresh inflow. Increase in net worth means increase in either share capital or reserves and surplus. Decrease. What will decrease it? Portfolio depreciation, expenses, redemption, dividend paid. And with this, you have opening units, new units issued, redemption. This is another way of calculating NAV. And you pause and solve this question. Pause, 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 and solve question 12. Pause and solve question 12. Impact of events on the net asset value of the mutual fund. 1. Fresh purchase or redemption. What is fresh purchase? Somebody is coming into the mutual fund. Redemption means somebody is exiting the mutual fund. This will not change my NAV. This will not change my NAV. If a person comes in, earlier it was 2 lakh into 35, 70 lakh was the value. Person comes in, he will give extra money. Let's assume he gives extra 35,000. I'll allot him extra 1,000 units. So units will go up, value will go up, NAV will remain same. NAV will remain same. Second is dividend declaration. If you declare any dividend, if the MF declares dividend, net assets of the MF go down. Net assets of the MF go down. How does asset go? If you declare dividend, what will happen? The dividend will have to be paid in cash. Cash will go down. Cash will go down. Assets will go down. NAV will go down by the amount of dividend per unit. NAV will go down by the amount of dividend per unit. NAV will go down by the amount of dividend per unit. NAV will go down by the amount of dividend per unit. One important point is, let's assume NAV is 20. Declared dividend of 2 rupees. NAV will now become 18. If you are doing a dividend reinvestment plan, understand the terminology or understand the working. Dividend declared, NAV fell, dividend will go to the investor now. Dividend is reinvested by the investor. Reinvestment will happen at 18 rupees. Reinvestment will happen at 18 per unit. Reinvestment, any reinvestment will happen at revised NAV post fall. Understand the the chronology. Dividends are declared, NAV has fallen. After the NAV fell, dividends are reinvested. After the NAV has fallen, dividends are reinvested. After the NAV has fallen, dividends are reinvested. After the NAV has fallen, dividends are reinvested. In this scenario, whenever reinvestment happens, you will have to allot the units. You have to allot the units at the revised NAV post the fall. Revised NAV post the fall. Clear? I think with this we are done with concept till 12. Concept 12 is done. Okay, next concept is total yield of investor. What is this? Let's understand now. See, sometimes it is possible that an investor, when he is investing, he is not investing in single MF. He is investing in MF A, B, C, D, multiple MF. For example, total yield. I purchase particulars MF A, MF B and total. Investment value 1 lakh, 2 lakh, 3 lakh. Closing value 1 lakh 50, 2 lakh 20, 3 lakh 70. I also got dividends in between. Dividends earned 20,000, 30,000, 50,000. Return. I can calculate return for MFA separately, MFB separately, or for total. If you calculate for total, that is called total yield. That is technically called total yield. So what is the return the MF is earning? What I get back 150, what I give 1 lakh, and also I get dividend income. So I approximately earn 70,000 and return percentage is 70,000 on 1 lakh. 70% is what the investor is earning. 70,000 or 70%. Investor to investor 2 lakh. Maturity 220. Dividend also he got. So 220 plus 30 minus 2 lakh. He has earned 50,000 and this 50,000 on 2 lakh is 25%. This is MFA investment, MFB. Question may ask total yield. Total means both club together. What is both club together? 70 plus 50, 120 or 370 minus 3 lakh, another 50. And this 120 on 3 lakh is 40%. First MF 70%, second MF 25%. Together if you do calculation, that is 40%. That is 40%. Capital gain of all MF, dividend of all MF, dividend of all MF. This capital gain is different from capital gain distribution. Okay, The capital gain distribution is called CG1. Capital gain is basically the closing value minus the opening value of the investor. So he is earning 16 here, some negative 19 here, 32 here. Put together what we earn divided by what I invest into 100. This is called total yield of the investor. I hope this is clear. Total yield is when you are investing in multiple mutual fund. If you are investing in only one mutual fund, obviously I cannot calculate total yield, and on single mutual fund you separately calculate. Together club it and calculate. Put a total column in the table itself, put a total column and then calculate. You can solve this example if you wish to. Okay, next concept. This is a very good concept. Next one. Exit load versus underperforming mutual fund. I first explain in a Word document and then I show it in the concept book. Okay. I am investing in 3 funds. Okay. I'm investing in 3 funds. Particulars, MFA, MFB, MFC. Return 12%, 18%, 24%. Okay. Now, this is the return which is being earned by the investor. Question says, for the next year, similar returns will continue. For the next year, similar returns will continue. What is your advice to the investor? I'll repeat the example. There are 3 mutual funds. Return you have calculated as NAV1, NAV0, DE1, CG1 divided by NAV0. You have done the calculation. 12, 18 and 24. What is your advice to the investor? Simple advice. Go ahead and redeem MFA and MFB. Put entire money in MFC. Put entire money in MFC. Very simple advice. This is a simple advice I'll give the investor. Please redeem your mutual fund A and mutual fund B and put the entire money in mutual fund C. Put the entire money in mutual fund C. If at all you are asking me advice for the next year, I have 3 funds. There are questions in your study material or in my question bank around this. So sell all the 2 funds, MFA and MFB, put the entire money in MFC. Then comes a variant, which is a very good example. Period of investment. I've already done the investment here. Here we have completed 240 days. Here we have completed 300 days. And here we have completed 100 days. Exit load if exit within 365 days. If you exit within 365 days, you will incur 5%, 5%, 5%. That's an exit load. There is a exit load if you exit within 365 days. Now, I need to now think, what advice will I give the company? I'll repeat the example, very good example. Earlier, 12, 18, 24. 24 best, sell A, sell B, put entire money in C. Now, A and B are bad only. But if you exit, you have to pay 5%. If you exit, you have to pay 5%. You have to pay 5% if you exit. Already 240 days invested. Can I wait for another 125 days? Can I wait for another 125 days? I'll explain again. 12, 18, 24. Period of investment is 240 days, 300 days and 100 days. MFC no exit. MFC no exit, so doesn't matter. Okay, MFC is the best MF. MFA loss in return for another 125 days. What is another 125 days? Loss in return of mutual fund A. Loss in return of mutual fund A. Mutual fund A, there is a loss in return. We have already invested for 240 days. Another 125. What is the loss? 24 minus 12 into 125 days by 365. Can I afford to lose this? Another 125 days you have to lose. If you lose this, you can say 5%. If you lose this return, you can say 5%. Loss in return for another how many days? 125 days, 240 days already done. Can I wait? Can I wait? Can I wait for another 125 days? Can I wait for another 125 days? If I wait for another 125 days, if I wait for another 125 days, I lose 24 minus 12 for a year. 24 is for a year, 12 is for a year. 24 is for a year, 12 is for a year. 24 minus 12, 125 by 365. The loss is 4.1%. The loss is 4.1%. My advice will be wait with the bad fund. Wait with the bad fund. Or let me change the exit load. Okay. Let me change the exit load. It is 3%. I'll change it as 3%. Okay. In this case, if it's 3%, it is better to incur exit load of 3% and shift immediately to mutual fund C from mutual fund A. Exit load 3% only. So shift immediately. Reason is, if you wait, you will lose 4.1%. Another 125 days, you have to play a waiting game. When it comes to mutual fund B, already 300 days over. Already 300 days over. Can you wait for 24 minus 18? 65 upon 365. 24 minus 18. 65 upon 365. Another 65 days. 665. 365. The loss is 1.07%. Obviously, I will not incur exit load. I will not incur exit load. Exit load is 3%. Why should I incur 3%? And I'm okay to lose 1.0. See, either you lose 1.07 or 3%. Either you pay exit load or pay 1.07. Pay 4.1 or exit load. We said we will pay exit load. Shift immediately here. It is better to wait for another 65 days and then shift to mutual fund C. I'm going to shift. Shifting is sure. Shifting is guaranteed to happen. But let us play a waiting game in case of one mutual fund, and in case of other mutual fund, no waiting game. One mutual fund will play wait, not 65 days, not 125 days here, 65 days. What is 65? I have to go till 365. I have to go till 365. I have to go till 365. 240 to 365, another 125 days. 300 to 365, another 65 days. Another 65, wait, lose 1.07%, save 3%. Another 125 days, don't wait, earn extra 4.1 and pay 3%. Pay 3%. No exit load, exit immediately. Exit load exists, check proportionate loss. Best fund, underperforming fund 24 minus 18 or 12 depending on which fund you are evaluating. Balance days 365 minus 240 or 365 minus 300 and then decide. You can pause the video and do this example immediately so that you get better grip on this concept. It's a good concept. Cash balance computation to value NAV. Now, in my assets, cash balance concept, cash is one of the asset of mutual fund. Cash is one of the asset of mutual fund. Closing cash balance given, take the same as asset for NAV computation. If they are given the closing cash balance, very simple, take the same as the asset for NAV computation. Closing cash not given, but all transactions are given. Closing cash not given, but all transactions are given. What is this? I'll show you an example. Closing cash not given, but all transactions are given. A mutual fund made an issue of 1 lakh, 10 lakh unit at 10. This is initial. Investments are made. During their dividends was received. Interest is received. Find out the NAV and some expenses have been paid. So if you can track all the cash flows, calculate the closing cash. If you can track all the cash flows, if you can track all the cash flows, if you can track all the cash flows, but all transactions are given, prepare cash book and compute closing cash. Closing cash not given, transaction not given, ignore it, that's all. No cash account, no cash as an asset, no cash or bank, whatever it is, no cash as an asset. Tracking of cash inflow and outflow not possible. You cannot track it, record cash as an asset if given, else ignore it. Possible, prepare cash book. In opening cash, inflow, sale, dividend, interest, other income, purchase, expenses, redemption, dividend, closing cash balance. If you can calculate the closing cash, calculate it. If you cannot calculate the closing cash, ignore it. If you cannot calculate the closing cash, ignore it. If available, so 3 scenarios I have told you. Cash balance given, take it directly. Cash balance not given, but tracking possible, calculate the cash balance. Cash not given, tracking not given, ignore the cash. Ignore the cash as an asset. Clear? Okay, next. Dividend income on equity shares invested by mutual fund. Now, what is this? Why a separate concept? Let us understand. A MF buys 10,000 shares of A Limited on 1/4/2026. On 1/4/2026, 10,000 shares of A Limited. The A Limited declared bonus of 1:10 and dividend of 10% on face value, 10% on face value, 10% on face value on 31/3/2026, or not 31/3, let us take 31/1/2026. Face value is ₹10 per share. Very good example. This got tested in one exam. I keep giving example from there only. So a mutual fund buys 10,000 shares. A Limited declared bonus. So once the bonus is declared, number of shares post bonus 10,000 plus extra 1/10, 11,000 shares. The problem is now dividend income, because this will come in the cash book. Dividend income of the mutual fund. Mutual fund is going to get this income. Mutual fund is going to get this income. Dividend income which the mutual fund is calculating, or which the mutual fund is going to write. Dividend income which the mutual fund is going to write is it. Dividend income, the dividend income which the mutual fund is going to write, is this dividend income, is this dividend income 10,000 shares into 10 into 10%, or 11,000 shares into 10 rupees face value into 10%. This is the question. Concept is very simple. Original shares, yes. Any rights or bonus share will not be applicable. Income will not be applicable if the dividend is declared before the allotment of bonus or right share. The dividend was declared on 31/1/2026. By that time, bonus share did not come, or right shares did not come. If you have not got those shares, how will you get income on those shares? So your dividend income will only be on 10,000 shares. In case bonus is on, listen, bonus on 31/1, dividend on 31/3, then dividend will be on 11,000 shares. Dividend will be on 11,000 shares. This you can pause and do the exam. With this we have done another 4 concepts. You keep doing 4 at a time. So I do 4 concepts. At that time you pause and maybe go through all the 4 concepts. 1 to 4, 5 to 8, 9 to 12, and now we are done 13 to 16 chain. Any doubts till this? I hope it is clear. Keep solving the MCQs by pausing the video along with me. Some MCQs I do, some MCQs I give an example, I do something else, you have to do something else. I think same 10,000 shares, okay, same 10%, okay, same number, sorry, the numbers are same. I took an example, but it is the same numbers. Clear? I hope it is clear to you. Okay, concept 17, dividend equalization concept, a practically irrelevant concept. ICI, I don't know why they still have this in the material, and questions have been coming and continue to come on this concept. Let us first understand what is this. Dividend equalization along with income available for distribution. Two concepts together we are going to do. First thing is, mutual fund declares daily NAV. If it does, no concept of dividend equalization. No concept of dividend equalization if you are declaring daily NAV, which is what market does. Every mutual fund is required to declare NAV on a daily basis. So this concept should not exist in the practical world. MF is declaring daily NAV. There can't be any concept of dividend equalization, because declaration of NAV on a daily basis is one of the duties of the mutual fund, and if they are performing that duty, where does the concept of dividend equalization come? Okay, then MF not declaring daily NAV. We need some adjusted NAV, and we use dividend equalization for this purpose. What is this purpose? With an example only. Best is to do with examples. Okay. Particulars, number of units per unit value. Okay. Number of units per unit and value. Where does the concept come? How does the concept come? We'll keep understanding it. Now, day zero, we have 1 lakh units at, 100 per unit NAV. Okay, 1 lakh units at 100 per unit. The NAV is given. Jan, Feb, March, 3 months are there. January month, 1 lakh, day 0 is Jan 31. Okay, this is Jan 1. Extra 20,000 units are allotted. At what NAV? No idea. At question mark NAV. Feb 31, 5,000 units are redeemed. At what NAV? No idea. I don't know the NAV. 20,000 units came in and 5,000 units are going out. Now the concept says, or the question says, Jan NAV equal to opening NAV plus 2% entry load or 2% extra load adjusted for dividend equalization. The Jan NAV is, this is what the question says, opening NAV 2% extra load adjusted for dividend equalization. I'll explain what is dividend equalization as we go through the example. Feb NAV, opening NAV, which is the 100. Okay, opening is the whatever we have, minus 2% exit load adjusted for dividend equalization. So if somebody says a person is entering on Jan 31, practical world, very simple. Calculate January NAV. Calculate January 31 NAV, all assets minus all liabilities. Feb 28 you want to do, again calculate the NAV. So you can very well calculate the NAV on a daily basis and end the story. If you are doing on daily basis, the story is over. I am not understanding what they want us to do by doing something called as dividend equalization. But let's understand now. Income of January. In January, we had 1 lakh units. And the question said, we earned an income of 2 lakh rupees. So per unit is 2 rupees. We earned an income of 2 lakh rupees. Per unit is 2 rupees. Per unit is 2 rupees. They'll give income, January income separately, Feb income separately, March income separately. Okay. 1 lakh units were there. 2 lakh is the value. And per unit, we have earned 2 rupees. Now, at the end of Jan, somebody is coming in. What concept says is dividend equalization adjustment for January. What is this is, whoever is coming in, he has to pay 20,000 into 2, 40,000. Whoever is coming in, and now revised total, it is 120, 2 and 240. What does this mean? After this, whoever came in Jan 31, no, he will enjoy this income also. He will enjoy even the previous month income. He will enjoy even the previous month income. So whoever is coming in January, he has to pay 100 plus 2% of 100 and 2 rupees dividend equalization. 104 he has to pay. 104 he has to pay. 100 plus 2% extra load plus extra 2 rupees as his share of dividend equalization. Why is this done? This will be for your better understanding. We'll pass a journal entry. Bank account debit 104 to share capital account 102. Share capital 102 and to P&L account, that 2 rupees. 2 rupees is the dividend equalization. This 2 rupees will go to the P&L and will increase the income available now. And now the person will get a share of entire 2 lakh 40. Now we'll get a share of entire 2 lakh 40, 1 lakh 20. Then I hope it is clear. I'll repeat again. January NAV is equal to opening NAV plus the 2% extra load adjusted for dividend equalization. Extra load is extra 2% that can go to share capital or that can also go to P&L. I'm not more interested in the journal entry part. And another 2 rupees is the dividend equalization, which will obviously go to P&L. Okay. Feb. Income of Feb is now on 1 lakh 20. Let's assume we earned 360, 3 rupees per unit. 3 rupees per unit. Revised total. 6 lakh is the value. 1 lakh 20 units, 5 per unit, and 6 lakh is the value. 1 lakh 20, 5 per unit, 6 lakh is the value. What is the use of this? February, when a person is going out, how many units are going out? 5,000 units are redeemed. When a person is going out in February, listen, when a person came inside on January, he had to bring extra 2 rupees, his share of January income, because he will enjoy. See, a person comes in January, and let's assume in March company pays a dividend. He will get the income of Jan, Feb and March. All the 3-month income will come to him. But January he was not there. He brought his share of dividend equalization. Feb, when a person is going out, less. Feb, when a person is going out, amount paid on units on redeemed, on redemption. People who are going out, they will take 5 rupees and go out, and revised value 1,15,000 units into 5,75,000. I'll explain this again. We had at the start 1 lakh unit. I earned 2 rupees, 2 lakh rupee. If you have come in, then you pay 2 rupees and come inside. 20,000 into 2, 40,000. Then in February, I earned extra 3. So 5 rupees per unit is there. If you are going out, take your 5 rupees and go. Take your 5 rupees and go. Take your 5 rupees and go. If you are coming inside, bring 2 rupees in January. If you are coming inside in February, bring 2 plus 3, 5 rupees. Bring 5 rupees inside. So the Feb NAV is going to be, 100 minus 2% exit load, extra 5 rupees I have to pay him. I have to pay him 5 rupees. Dividend equalization will always be added, 103 would be paid. Where is this done in a question? It is there in the ICI study mat. I'll show you the question. This is the question. April income, May income, June income, opening NAV adjusted for dividend equalization, repurchase, opening NAV less 2% adjusted for dividend equalization. Dividend equalization adjustment has to be done. You can do this question parallelly after this concept is done. Question 19. So what is NAV here? Opening NAV plus the entry load plus the dividend equalization per unit. Opening NAV minus the exit load plus both place plus dividend equalization per unit plus dividend equalization per unit. Then after this, maybe there is a income of March 1,15,000. Let us assume that income is 4,64 per unit. This is called income available for distribution. Income available for distribution. Income available for distribution. In case you want a lengthy question to be solved on this concept, lengthy question is you want the full problem to be solved, then there is a video available in my YouTube channel. You can see that video, but concept is this much only. This is what is called income available for distribution. You see here, income of month 1, inflow from MF buyers, in total income, redemption in month 2, it can be inflow, it can be of redemption, income of month 3, income available for distribution, dividend distributed, balance income, dividend distributed, balance income, income available for distribution. From this, I will say less dividend paid. So person who came in January, he will get 9 rupees income. Assuming we paid 80% of this, 7 rupees 20 paise, 80%. 80% I am paying dividend. 80% I am paying dividend. 80% I am paying dividend. So that is your dividends paid. So person who came inside in January got Jan income, Feb income, March income, got Jan income, Feb income, March income, got Jan. So that is why January income he had to contribute. He has to contribute his share of January income and then take Jan, Feb and March. Net amount available or balance amount 1,15,000, 1 rupee 80 paise, 207, 115, 1 rupee 80, yeah, 207. This is the balance amount available. This is the balance amount available. So you have this computation: income of month 1, total income till month 1, income of month 2, total income till month 2, income of month 3, income available for distribution, and balance. And question may ask you for this calculation. For example, opening NAV 20, April extra 1 rupee, 20 plus 2%, which is 40 paise, and 1 rupee is to be added, 21.4. 1 rupee is to be added. 20, 3% exit load, dividend equalization always add 1 plus 2, 3 rupees. 1 plus 2, 3. Dividend equalization always add. This concept, my advice to use, you can see the lengthy video if you are not confident on the concept. Okay, I'll share the link in the video description itself if you wish to see the video where a question is properly solved with full discussion. Otherwise, at a concept level, this is what it is. That's all. I think major chunk is done. 2-3 more concepts. Let's quickly close it now. Dividend out of realized earnings. Okay, this came in one exam. Very good point. Adjustment. Dividend out of realized earnings. What does this mean? A question says MF paid 80% of realized earnings as dividend to the investor. MF paid 80% of realized earnings as dividend to the investor. Okay. Now the only point is, what is realized earning? Meaning you have to understand. Now, income of mutual fund. Income of mutual fund. Interest income 2 lakh, part of realized income, whether received or not. What is received or not? Maybe it is received later also, but it is realized. Realized means it can go to P&L account. It can go to the P&L account. Accrued income we used to record in P&L. Interest income of the mutual fund. Dividend income 4 lakh, not received, but still part of realized income. It is still part because I can record it. I can record it. Receiving is only just a formality. Capital gain on sales 10 lakh, part of realized income. What is capital gain? On sale of, let me write it very clearly, on sale of shares of mutual fund. Mutual fund does buying and selling of share. So they bought and sold. And you may also have unrealized capital appreciation of shares 50 lakh, not part of realized income, not part of realized income, not part of realized income, not part of realized income. Why is this needed? Once you know this, 2 plus 4 plus 10 into 80% is the dividend paid. 2 plus 4 plus 10 into 80%. 2 plus 4 plus 10 into 80% is the dividend paid by the mutual fund. 2 plus 4 plus 10 into 80% into 80%. You will see an MCQ example. A mutual fund sold shares worth 80 lakh for 88, 8 lakh gain. 80 lakh for 88 lakh, 8 lakh gain. Sold another lot of 75 for 72, 3 lakh loss. 8 minus 3, 5. Income 4, 60%, 9 into 60%. 9 into 60%, 9 into 60%, 9 into 60%. Unrealized capital gain is there? Don't consider. Where was this tested? They have tested it multiple times. All these things have come in exam. I'll show you the question where this got tested by ICA. Questions can be at different places. I am not getting into questions discussion as of now. I'll show you that question. Distributed 80% of the realized earning. Distributed 80% of the realized earning. Sold instrument costing 60 lakh for 63 lakh. Clear? Okay. This is one part. Last is, okay, valuation of equity shares and bonds for NAV computation. This I've already discussed in an example. That TCS example is that formula. Here we did that example. Purchase of TCS shares 20 lakh. Index on the date of investment. So amount invested, let me write the formula, 20 lakh into closing index value 2500, opening index value 1000, and you calculate the value. You calculate the value. This is one approach for equity shares. I have an example which is little trickier. You see the example later. Pause and see that. That is little different. Okay. Bonds valuation, what will we do? Okay. Let us understand bonds valuation. Anyway, it's learned as part of security valuation, but still okay. Bonds, and CA interview would have learned, cost of debt equal to interest divided by net proceeds. Interest divided by net proceeds. Net proceeds is nothing but mostly current market price. So cost of debt is called current yield. Current yield interest is interest only, divided by CMP. Net I can say CMP is equal to interest divided by current yield. Interest divided by current yield. What is this? Let's take an example. Cost of debt is interest divided by current market price. Cost of debt is called current yield. Yield means return. Cost means from a company point of view it's called cost. From an investor point of view it's called yield. Interest by net proceeds CMP. Example. Our investment 10,000 debentures of rupees 100 each, paying 12% interest. Current yield 8%. What is the fair value of one debenture? One debenture, I'll do the calculation. Fair value of one debenture. Fair value of one debenture. Current market price or fair value is equal to interest by current yield. Interest is 100 face value into 12% divided by current yield, which is 8%, and you get 150 per debenture. 150 per debenture. 100 into 12% divided by 8%. 100 into 12%. Interest is paid at the face value. If debentures of rupees 100 each, we paid 110. Still it will be 150 only. You paid 110, doesn't matter, okay? Because interest is paid only on face value. Interest is paid only on face value. On face value. Value of listed bonds 20 crore. Face value 15 crore. Interest will be paid only on face value. Interest will be paid only on face value. Market expectation. Market expectation is current yield 7%. Value of bond is equal to interest by current yield. On face value pay interest 15 CR, 14% divided by 7%. 15, not on 20 CR, on 15 CR. On 15 CR, pay 14% divided by 7%. Pay 14% divided by 7%, 30 crores. Clear? This is on bond valuation. Anyway, you will learn in depth when you do bond valuation concept discussion. Okay, I have one more concept, expense ratio. And after this, performance evaluation areas there, which we are not doing now. Performance evaluation, you will see the discussion as part of portfolio chapter. I'll be putting this as part of the portfolio chapter. I don't want to put it as part of the mutual fund chapter. Once portfolio is fully discussed, at the end of the portfolio chapter, you will see me adding this there, okay? Because you will not understand now certain points there. Okay, expense ratio. We've already learned what is expense ratio. Amount incurred by mutual fund, office expenses, rent, fund management expense, expenses, etc. What will you do? You first calculate expense per unit. What is expense per unit? I incur 1000 lakh and number of units is 500 lakh, 2 per unit. This 2 per unit will be ultimately expressed as a percentage. 2 per unit will ultimately be expressed as a percentage. What is the percentage? 2 can be divided by opening NAV, 2 can be divided by closing NAV, 2 can be divided by average NAV. Have not been tested in exam, but anytime ICI can test anything. We have already seen what kind of difficult paper they have set. So 2 by opening NAV, 2 by closing NAV. If information is not there, give 3 answers. With this, expense ratio discussion is also over. I've done an exhaustive discussion on concepts, purely concepts. With this chapter is over. The other segment of this chapter will come to you from the portfolio chapter. When I do MF portfolio, there I'll do MF performance evaluation. Thank you, friends.